Welcome back. I'm really glad you're here because what we're covering today is the foundation of everything. Before you ever think about buying a call or selling a put, you need to understand one thing. How does price actually move? And more importantly, why? This lesson is all about price action and trend direction. It sounds technical, but I promise by the end of this, you'll look at a chart completely differently. Let's dig in. What price action actually is. Price action is simply the record of what buyers and sellers have done over time. Every single tick you see on a chart represents a transaction. Someone decided to buy, someone decided to sell, and they agreed on a price. That's it. The chart is nothing more than a scoreboard of those agreements. Now, why does price move up or down? It comes down to supply and demand. When more people want to buy a stock than sell it, price goes up. Buyers have to keep offering higher prices to attract sellers. When more people want to sell than buy, price goes down. Sellers have to keep dropping their ask to find buyers willing to step in. Think of it like a live auction for a house. If 3 buyers are bidding on one house, the price goes up. If 3 houses are competing for one buyer, prices fall. The stock market is just an auction, happening millions of times a second every trading day. Understanding this tells you something important. No chart pattern, no indicator, no formula is magic. All they're doing is helping you interpret that underlying auction. Keep that in mind as we go through this lesson. Candlestick anatomy: open, high, low, close. The most popular way to read a chart is with candlesticks, and once you understand what a single candle is telling you, everything clicks into place. Each candlestick represents a specific period of time. Could be 1 minute, 1 hour, 1 day, and it shows you 4 things: the open, the high, the low, and the close. The open is where price started during that period. The close is where it ended. The body of the candle, that thick rectangle, represents the distance between those two. If the close is higher than the open, the candle is typically green or white. Buyers won that round. If the close is lower than the open, the candle is red or black. Sellers won. But here's where it gets interesting. The thin lines above and below the body are called wicks, or shadows. The top wick shows you the highest price reached during that period. The bottom wick shows the lowest. Those wicks tell you about rejection. Price went there, but couldn't hold. Imagine a day when a stock opens at $50, shoots up to $58 during the day, but closes at $51. That long upper wick is screaming at you. Sellers showed up hard at $58 and pushed price back down. That's information you can use. Defining a trend: higher highs and higher lows. Okay, now that we can read individual candles, let's zoom out. How do we know if a market is trending up, down, or going nowhere? An uptrend is defined by a very simple pattern. Higher highs and higher lows. Each peak is higher than the last peak. Each pullback stops at a higher level than the previous pullback. The market is making consistent progress upward, like climbing a staircase. A downtrend is the opposite. Lower lows and lower highs. Each bounce fails at a lower level. Each dip goes deeper. The staircase is going down. And then there's the third condition: consolidation. Price is going sideways, oscillating between a ceiling and a floor with no clear progress in either direction. This happens when buyers and sellers are roughly balanced. Nobody has taken control. Why does this matter for you? Because you want to trade in the direction of the trend. A wise old saying in trading is, the trend is your friend. Fighting a strong trend is one of the most expensive habits a beginner can have. Support and resistance. Why price reacts at certain levels. You'll notice on almost any chart that price seems to bounce off certain levels repeatedly. These are called support and resistance levels, and they're one of the most important concepts in all of technical analysis. Support is a price level where buying interest has historically been strong enough to stop price from falling further. Think of it as a floor. Every time price approaches that level, buyers step in. Resistance is the ceiling, a price level where selling pressure has historically stopped price from going higher. Sellers show up, supply overwhelms demand, and price gets pushed back down. Here's the interesting part. Support and resistance aren't random. They form at levels where a lot of people made decisions, maybe where a stock reversed sharply in the past, or where a big round number sits like $100 or $200. Human psychology plays a huge role here. People remember where they bought or sold, and they tend to make the same decisions again at those same levels. And one more thing, when support breaks, it often becomes resistance. When resistance breaks, it often becomes support. The roles flip. It's as if the market has a memory. Key reversal patterns: pin bars, engulfing candles, inside bars. Now let's talk about specific candlestick patterns that signal potential reversals. These are moments when the balance of power between buyers and sellers shifts and price may be about to change direction. First, the pin bar. This is a candle with a very small body and a long wick on one side. That long wick tells you price was forcefully rejected. A pin bar with a long lower wick at a support level, that's buyers stepping in hard and pushing price back up. It's one of the cleanest reversal signals you'll find. Second, the engulfing candle. This is when one candle's body completely swallows the previous candle's body. A bullish engulfing candle, a big green candle after a small red one, signals that buyers have overwhelmed sellers and may be taking control. A bearish engulfing does the opposite. Third, the inside bar. This is a candle whose high and low are completely contained within the previous candle's range. It shows compression. The market is coiling up, deciding which way to go next. When it breaks out of that range, the move can be powerful. These patterns work best when they form at meaningful levels, at support, at resistance, after a prolonged trend. Context is everything. Moving averages as trend filters. Moving averages are one of the most widely used tools in trading, and for good reason. They help you cut through the noise and see the underlying trend. A moving average simply takes the average closing price over a set number of periods and plots it as a line. The 20-period exponential moving average, or 20 EMA, responds quickly to recent price changes. The 50 EMA is slower. The 200 EMA is slower still. It shows you the long-term trend. Here's how traders use them practically. If price is above the 200 EMA, the stock is in a long-term uptrend. If it's below the 200 EMA, it's in a long-term downtrend. The 20 or 50 EMA acts as a dynamic support or resistance level. Price often bounces off them during trends. Think of moving averages as guardrails rather than signals. They don't tell you exactly when to trade. They tell you the direction you should be looking to trade in. A pullback to the 20 EMA in an uptrend, that could be your entry zone. A rally back to the 20 EMA in a downtrend, that's often a selling opportunity. Reading market structure, consolidation versus impulse moves. Markets don't move in straight lines. They move in what we call impulse and consolidation phases, and learning to recognize each is a massive edge. An impulse move is a strong directional move. Price covers a lot of ground quickly, usually on increased volume and momentum. This is where most of the money is made. Consolidation is the rest period that follows. Price moves sideways, catching its breath. Volume dries up. The market is digesting the previous move and deciding what to do next. The key insight: after consolidation, price usually resumes in the direction of the prior impulse. So if you see a strong uptrend followed by a tight sideways consolidation, the odds favor a continuation upward. You can plan your entries around these breakouts. Multi-time frame analysis. The daily sets the direction. This one concept alone separates intermediate traders from beginners. Successful traders don't just look at one time frame, they look at multiple, with each serving a different purpose. The daily chart sets the overall direction. If the daily chart shows a strong uptrend, that's the bias you trade with. The 4-hour or 1-hour chart helps you time your entry with more precision. The 15-minute chart can help you fine-tune your exact entry point. The rule of thumb: higher time frames always take priority. If the daily chart is bearish, but you're seeing a bullish signal on the 5-minute chart, be very cautious. That intraday move is likely swimming upstream. Think of it like this. The daily chart is the ocean current. The intraday chart is the waves on top. You might catch a wave going against the current for a moment, but the current will win eventually. Volume confirmation. Does the move have conviction? Price alone doesn't tell the whole story. Volume, the number of shares or contracts traded during a period, tells you how much conviction is behind a move. A breakout above resistance on high volume That's a powerful signal. Lots of participants are engaged. Lots of money's moving. That move is more likely to follow through. A breakout on low volume, be skeptical. It may be a false breakout. A trap where price briefly crosses level and then reverses, leaving late buyers stuck. As a general rule, trend moves should happen on rising volume. Pullbacks and consolidations should happen on shrinking volume. When you see the opposite, pay attention. Something may be changing. Building your trend checklist. Let's bring it all together. Before every trade, run through this quick checklist. 1. What is the daily chart trend? Higher highs and higher lows, or the opposite? 2. Where is price relative to the key moving averages? Above the 200 EMA is bullish territory. Below it is bearish. 3. Is there a nearby support or resistance level that matters? 4. What candlestick pattern or price action signal am I seeing at this level? 5. Is volume confirming the move? 6. Does the intraday time frame align with the daily direction? If you can check most of those boxes, you have a high quality trade setup. If you're fighting the trend, arguing with the volume, or forcing a pattern that isn't there, step away and wait. Price action isn't about predicting the future. It's about putting the odds in your favor. And that's what every lesson in this course is designed to do. In our next lesson, we're going to take all of this, the trend direction, the price levels, the timing, and we're going to apply it specifically to the world of options.